Welcome to Growth Investing Mastery. This video will look at our 2025 year-end portfolio review. As a reminder, this is not investment advice or recommendations to buy any stocks. The purpose of this video is to review our growth stock portfolio at the end of 2025. We have a disciplined and comprehensive strategy which gets results. And we had a record number of promising new ideas on the month. So make sure to stay around till the end of the video to check out those. We also did a recent collaboration on the Shooting the Bull podcast. We had a really interesting discussion of growth stocks and the market. I'll put a link to that podcast in the video description. Getting into our allocations, we have 4 high confidence positions. At the top of the list is Astera Labs ALAB with 19.1%. That's followed by AppLovin APP at 18.4%, Iren, symbol IREN, at 13.9%, Electrovaya ELVA at 12.8%. Then we have 6 medium confidence positions. These include Hive Digital Technologies, Hive at 7.1%, FIGR Technology, FIGR at 6.7%, Reddit RDDT at 4.4%, Dave Inc. Dave at 4.1%. Next we have Paymentus PAY at 3.1%, DUOT Technologies DUOT at 2.9%. And then we have 6 low confidence positions. These include Credo, CRDO at 1.6%, SkyWater Technologies, SKYT at 1.5%, BioHarvest Sciences, BHST at 1.3%. And we do have 2 new positions on the month. These include Pattern Group, PTRN, 1.1%, Shoals Technologies, SHLS at 0.9%. Then lastly, we have Organigram OGI at 0.9%. Taking a look at our results, in 2024, we were up 146%. And in 2025, we ended the year up 112%. That makes the cumulative return over the past 2 years, or since the start of 2024, as plus 422%. I've included the graph here of the last 2 years of results. And you can see how many ups and downs there have been with growth investing over the past 2 years. But you can also see if you drew a line from the start to the finish, the graph is going up at a very nice angle. In 2025, our results were especially choppy as the market moved around a lot. Our graph was rising for most of the year, except for the 2 big crashes in March and November. With growth investing in individual stocks, it's a higher variance style than other investing styles, but it usually leads to a higher return like we achieved. I wanted to start off here with a small commentary about our portfolio at year-end. Our portfolio saw wild swings this year, but we outpaced market returns significantly. Throughout the year, we stuck to our strategy of staying fully invested, and we're investing in the most compelling market opportunities at all times. One question that I've been left wondering at the end of the year is if 100% plus returns are sustainable now in the long term. Something I've been thinking about is that companies can scale up faster than ever with AI and technology. And the lower operating expenses from technology means greater company profitability. The market is still struggling to price emerging industries, and our edge lies in finding these promising market opportunities early. But we want to wait until the objective results show that a company is accelerating. So we aren't looking to predict company or industry trends. We wait for the companies to first show us they're doing really well, and then we get in. Jumping into the individual stocks, our highest allocation position is Astera Labs with symbol ALAB. Their product is AI Infrastructure 2.0. And they recently presented at the Barclays and Raymond James conferences in December. The quotation that really stood out to me was about the market for AI. They said the orders that we have from our customers don't seem to show any sign of slowdown. So if there is any talk of AI slowdown, etc., we're not seeing any of it in our business. The management team also detailed that their CXL product called Leo is ramping up for general purpose compute, and that's a partnership with Microsoft as well. Regarding revenue from their product line Taurus, they said they're seeing a nice step up, and Taurus will be our biggest driver of growth in Q4. They're ramping into the 400 gig solutions for Taurus with the lead customer, and then they'll be moving into 800 gig solutions. Additionally, the company is engaged with over 10 customers on the Scorpio X family for scale up using the open standard of PCIe. The marketplace for AI networking is now seeing more complex solutions, bigger chips, and faster solutions. And that leads Astera to getting over $1,000 threshold per accelerator. In these tech conferences, the management team detailed how they believe many will just move over to UA-Link because their software stack is already optimized for it. They said that going from PCIe to UA-Link is just the same thing, but runs a lot faster. And that was the first time I heard it explained this way, so it sounds like the transition to UA-Link will be pretty seamless. And it's also based on open standards, which are good for Astera. Content is growing with every generation of GPU and XPU. In the term XPU, the X there is just a wildcard to indicate any type of chip, whether it's a CPU or GPU. We are very confident that our content goes up, the management team said. And they also detailed, hyperscalers got us invited back to the party to do more. And they said that hyperscalers told them, we need you to solve this challenge. On application-specific chips called ASICs, the market is much bigger in this environment versus the NVIDIA environment. And so the size and the scope of these customized chips is really growing a lot now. The company is also building out multi-generational roadmaps with the hyperscalers that they are attaching to. And they also detailed we're building up a very large balance sheet. Lastly, one of the analysts noted that the stock gets knocked around with the headlines. And my take there is the market has trouble pricing Astera Labs because there's a general lack of understanding of their role in the industry. Our next highest confidence position is AppLovin with symbol App. Their product is an ad tech platform that's expanding to global reach. Recently, this company gave additional details about their business at the UBS and NASDAQ investor conferences. And the web platform is set for a full launch in Q1 of 2026. Early feedback that management has been getting from customers is that the web pilot is working phenomenally well. And they said they're not hearing anything negative about the platform now anywhere. Something that was surprising from one of these conferences is the company said their employee count is down to only 900 employees. We had previously said they had 1,600 employees, but that may have still included the legacy gaming business, and the company is trimming down their employee count as well. The CEO said we're probably the world's largest startup. Right now, they're focused on the mid-market e-commerce across a variety of categories. One direct quote they had was, we have an opportunity in front of us to go acquire hundreds of thousands of customers. And that makes the potential future opportunity even bigger than it was before. They mentioned that unlocking AI creatives to build ads in an automatic way will be much cheaper for customers. And I like that they still have an underdog mentality. Another direct quote was, we're coming in with basically no salespeople. We have the name AppLovin. So they're even aware that their name is a bit ridiculous. They also added in these conferences that it's the first time in a long time there's a new solution in the market. And they added, once the full launch of the web platform completes, this business is going to be off to the races. And I added here, the huge growth with tiny operating expenses presents an opportunity. The stock may be getting fully valued now with its recent run-up, but we still see upside with the upcoming full product launch. The next high confidence position we own is Iren with symbol IREN. And the company is a neo cloud for AI infrastructure. Recently, Iren raised $2.3 billion with convertible notes in early December. And the rates for borrowing or raising capital related to AI have pretty good rates recently. So the company can raise this capital at a reasonable price with a decent interest rate. But this is a bit of a change in strategy as the company has been raising capital faster than anticipated. And this may be partly because competitors like Nebius did so first, raising $3 billion. And Iren's original goal was to use the Bitcoin mining to bootstrap for high-performance compute. But they also realize the demand is huge and the customers want the compute faster. So we're okay with these capital raises, but the market doesn't seem to like them too much. But I'm still pretty bullish about Iren overall. I believe they have superior unit economics to competitors like Nebius and CoreWeave. This is because the company does more of the build out themselves and they're less reliant on third-party contractors. Iren already has a lot of experience optimizing for power requirements and efficiency. And a few key takeaways are, it seems like the market's cooled off a lot for these neoclouds recently. But our take is a Microsoft contract lowers the overall risk profile for Iren a lot. This is because previous bear cases for Iren, which seemed legitimate, revolved around not being able to sell or to close contracts. And Iren also got a prepayment from Microsoft, which was not offered to any other neoclouds that made deals with Microsoft. The lower stock price, along with a better risk profile, presents a compelling opportunity right now. So we might be looking to add a little bit back now and trim somewhere else to build up in Iren a bit more here. Our next high confidence position is the company Electrovaya with symbol ELVA. Their product is next generation industrial batteries. And we did a full write-up of their latest earnings report over on Salesboard, and I'll put a link in the video description if you want to check that out. Shout out to the folks coming over to the channel from Salesboard. In this latest earnings, revenue for Electrovaya was $20.5 million on the quarter, which was up 77% year over year. Adjusted EBITDA was $3.4 million, and this was up 126% year over year. Additionally, the company got GAAP net income of $2 million versus negative $0.1 million last year. In the prior quarter had only $0.9 million of net income, so this was a decent sized step up in profitability. And I was impressed to see the profitability go up as they scale up production. This is in contrast to other next-gen battery makers. Many of their competitors are still not GAAP profitable, but they have much bigger valuations. Electrovaya's product is for performance, and it's not a commoditized product. Electrovaya's main business line is forklift batteries. And Walmart and Toyota buying these forklift batteries provides a stable base for the business. As they've said before, they have the most blue chip of blue chips as customers. The company is also expanding to robotics, defense, and airport ground transport. And that presents additional upside if Electrovaya can build a compelling product in one of those areas. Our overall take on the earnings was the story seems on track as the company expands its manufacturing base to the US. The next company we own is Hive Digital Technologies with symbol Hive, and they're a Bitcoin miner that's moving to high performance compute. The company recently raised $300 million from equity sales at the end of November, and this capital raise was done at the market prices. It seems like most of their neocloud competitors are also raising capital for expansions. And these capital raises may be part of the reason the market sentiment has cooled off here. Also, with Bitcoin being around 90K or lower, it may keep the stock price lower as well. The company is upgrading their Canadian and Swedish facilities to host Tier 3 and Tier 4 data centers for HPC. And with Bitcoin mining, Hive is currently at 25 exahash of hash rate on the Bitcoin mining network. They're expanding to 35 exahash in the near future. I put this infographic at the bottom, which was part of one of their press releases. It shows each location, the hash rate, the pipeline hash rate, the megawatt capacity, and the status. And there was no surprises here on this table, but it was nice to see the full breakdown. And the thing that stands out from the table is that most of the mining capacity is in Paraguay, and that's where they continue to plan expanding. There's about 5 exahash in Canada and about 2 exahash in Sweden. But some of those facilities in Canada and Sweden are the ones that are getting upgraded for high performance compute and requirements like liquid cooling. Our next medium confidence position is FIGR Technology Solutions with symbol FIGR. The company has a blockchain-based solution for real-world assets, sometimes called RWA. Our previous video on the channel Growth Investing Mastery is a full look at the company, and that video is worth checking out if you're interested in this company. There's not a whole lot of updates since the video, but the site rwa.xyz provides real-time tracking of blockchain. Since the video, the company is seeing steady and predictable growth of the loan counts and amounts. About 2 weeks ago, the active loan value was $14.13 billion, and now it's $14.37 billion. Total loans value roughly 2 weeks ago was $17.87 billion, and now it's $18.16 billion. So there was no surprises here. The graph is just going up steadily. We did discover a new special call transcript back in October that we didn't cover in the video. One of the main things they detailed in this special call was the recent blowup of competitors who were still using manual spreadsheets. And they actually called out 3 separate companies which failed recently. These were First Brands, Tricolor, and Cantor Group. And they all had problems either related to fraud or collateral issues. In the aftermath of Tricolor, the company says they saw increased requests for their platform with warehouse lenders. And FIGR's Portfolio Manager enables you to see all of your rights for the loans you own. The warehouse lender can then monitor the flow of funds continuously. So even though the warehouse lender might not be bidding or selling on FIGR's platform, just the visibility alone was worth something to them. And the traditional ecosystem for these home equity lines of credit are still manual and paper-based. Loan files are often held in file cabinets. One last takeaway from FIGR is we'll look out for the announcements on the SEC application with the blockchain stock market. That's one of the new features if FIGR can pull off that should boost the stock price. Our next company is Reddit with symbol RDDT and their community-based social media. There's been almost no news or press releases from Reddit since their latest earnings. The only real headline I saw is that the company is challenging the Australian social media ruling in court. And part of their claim is they do not fit the definition of social media. The other claim in this lawsuit is that the Australian ban limits open political discourse. And I think this social media ban was just to minors. It's not being blocked completely by Australia. Some takeaways with our strategy for the stock Reddit are that we'll wait until they post a disappointing result. I'm not looking to second guess too much, whether that's the data from the Google algorithm or the DAU numbers too much. But I'm still skeptical on the user growth here, so I'll likely keep this position smaller. And it seems like the data selling aspect of Reddit's business needs to be revamped if it's going to be successful. One key point that management has been making regarding their users is that Reddit users spend more time on the platform as they age. So the users spending the most time on their platform right now are the oldest users who may have joined over 15 years ago. This contrasts with other traditional social media where the oldest users are now dropping off. The company mentions there's still room to ramp up on ads to be on par with Meta and other competitors. And that's another reason we'll continue to hold until they have a disappointing result. Our next company is Dave Inc. with symbol Dave, and they're a membership-based bank for underserved consumers. Revenue in the latest quarter was growing 63% year over year, which was well ahead of guidance and analyst expectations. The profitability numbers for this business landed strong as well. Adjusted net income was $61 million, which is up 193% year over year. And some takeaways from Dave are that the last 2 quarters, the company has posted significant outperformances in their financials. But the market has kept the stock price flat during this time frame. And that's usually an opportunity when a company is overperforming, but the stock price is staying flat. Our biggest concern with Dave is regarding user growth. The platform is currently able to offer more features and grow out this way. But there could be a point where it becomes more challenging to grow that average revenue per user. Our next medium confidence position is Paymentus with symbol Pay. They are a payment platform for enterprises. And the company was recently at the Raymond James Technology Conference on December 9th. One quote from that conference was, "The size of the market expanded for us." The company's entering the B2B payment space where there's a larger TAM and more sophisticated workflows. They mentioned one very large B2B client taking payments from over 40 countries. And they said this client is significantly outperforming our expectations. Something to keep in mind with Paymentus is when this company went public a few years ago, they had $300 million of annual revenue, and now they have revenue of $1.2 billion per year. But the stock price has stayed flat during these years despite the stellar execution. And Paymentus still only has 4% market share of this enterprise payment space. The management team mentioned at the conference there's a force multiplier in outer years with more capabilities. Adding large customers is now business as usual activity, they said. They detailed how the business is not a significant working capital intensive business. A lot of the infrastructure is set up to run on its own now. And my one big takeaway here is that growing organically while increasing profitability is a great combination for a growth stock. The next company we own is DUOT Technologies with symbol DUOT, and their product is Edge Data Centers. On December 30th, the company had a press release detailing the launch of their Illinois data center, and this shot the stock up 15% on the day. The company had mentioned entering Illinois, so it should have not been a surprise to the market. But we definitely like to see the stock going up on an announcement like this. Additionally, they mentioned they're deploying an additional data center in Texas, which is their main market location. The announcement didn't give a whole lot of details on total count of data centers or any forecast, though. But they did mention that education and healthcare are top locations for customers and their setup. Their data centers support carrier-neutral co-location and enterprise workloads. And the company has SOC 2 compliance to be able to offer the very top tier of level 3 and level 4 data centers. So they can actually run a liquid-cooled Blackwell out of one of their edge data centers. A couple takeaways on Duos are that the idea is still very early stage, and I ended up deciding I wanted a slightly smaller position. I'm still enthusiastic about this idea and the company's execution, but the company is still relying on their legacy business. And we think their legacy business should be able to hold them off before the full transition to the new market of edge data centers. So there is some execution risk here that they can make this transition successfully. The next company we own is Credo Technology with symbol CRDO, and they do AI networking hardware. The company reported incredible numbers on their latest earnings, convincing us to start a small position again. We previously owned Credo at about a 7 or 8% position. Some of the incredible numbers they posted are with their revenue. They had guided from 230 to 240 million of revenue and landed at 268 million, which is up 272% year over year and 20% quarter over quarter. But the really big standout on this report was for their Q4 guidance, which is from 335 to 345, a 29% increase quarter over quarter. And it's just really rare to see a company re-accelerate their financials like this. Additionally, the profitability metrics were impressive. For GAAP net income, it was 83 million, and adjusted net income was 128 million. Adjusted gross margin is also going up. It's now 67.7%, and that was above the high end of their guidance range on margins. 4 hyperscalers are greater than 10% revenue contribution now for the company. And this is important because a few quarters ago, they had revenue of 86% from Amazon. But now there's a lot more customer diversification amongst their base. And the analysts were able to get out of management the following customer concentrations. The top 4 customers make up 42%, 24%, 16%, and 11% of the business. One direct quote was customer forecasts have strengthened across the board in the past few months. And that's really great to hear as an investor. It seems like there's no AI slowdown in their business. The company also mentioned they have 3 new growth pillars, which surprised us. The first is zero flap optics combined with their pilot software. The second is micro LED pluggable optical solutions called ALC cables. And the management team gave one shocking detail about ALC cables. They said that ALC cables have 2 times the TAM of AEC cables. And keep in mind the AEC cables are their main product line, generating most of their revenue right now. The third new product detailed was called OmniConnect gearboxes with the nickname Weaver. And these 3 new products add to their existing solutions of AEC cables and custom integrated circuit solutions. Our big takeaway here is the company seems to have turned into an innovation engine after we underestimated this company. The next company we own is SkyWater Technology with symbol SKYT. They're a semiconductor fab that's expanding to the quantum computing market. And in late November, they announced a partnership with Silicon Quantum Computing, based out of Australia. They describe this partnership as the commercialization of hybrid quantum classical computing. But no terms of the deal were announced, so it's hard to get a sense of how significant this deal may be. The company had mentioned on earnings that their quantum computing customers went up to 7. And they previously had just 3 quantum computing customers, so they added 4 in the latest quarter. One of the issues with evaluating this stock is they do not say how much this quantum revenue is, because it's likely small right now. Yet we like to see the company give more details about how much revenue is coming in from quantum before adding to this position. Some of these quantum customers are small and building prototypes right now. A significant portion of company growth comes from acquisition as well. But despite this acquisition, they outperform expectations significantly. We plan on holding till the next earnings, and we'll reevaluate if there's real growth here at that point. Our next company is BioHarvest Sciences with symbol BHST, and their product is plant-based exosomes in consumer products and manufacturing. The stock price has drifted significantly lower over the past couple months. And one thing we've been thinking about recently is their September special call had mentioned they're limited on manufacturing announcements. And they said this was because they have a confidential agreement with a biotech firm. They are the replacement in part of the supply chain, and they didn't want to disrupt the supply chain. But as an investor, we're left wondering, where's the announcement though? We're going to need more than just their word on this aspect of the business. And that earlier statement about manufacturing agreements has not been followed through on announcements or revenue yet. On the other side of the consumer business, the company's drinks for electrolytes is available now in Amazon in powder form. And the powder form makes up a majority of electrolyte drinks with performance athletes. So I was talking with a fellow investor who said they thought they were launching bottled drinks. And I think they have the potential to expand to the bottled drink form later. But from the study I saw, roughly 60% of the market for electrolyte drinks is in powder form. I also ordered some of the electrolyte drinks off Amazon to get a first-hand impression of how it looks. But overall, I'm keeping this company on a short leash now. I plan to hold some position till the next earnings, but I'd really like to see further developments with their manufacturing agreements. Our next company is a new one we added to in this month. It's called Pattern Group with symbol PTRN. And the company is an e-commerce accelerator for brands. Pattern Group recently IPO'd in September 2025 with their first earnings reported in this November. Part of their business model is buying brands' inventory and reselling it. They offer SaaS solutions, logistics, and service that helps customers grow on Amazon, Walmart, Target, and TikTok. However, the Amazon marketplace makes up a majority of their sales at 93%, but other marketplaces are starting to pick up now. The non-Amazon revenue marketplace revenue grew 81% year over year. And giving you some more basic details of this company's financials, they have a market cap of $2.5 billion. Q3 revenue came in at $640 million, which was up 46% year over year. The company has a gross margin of 44% and a healthy balance sheet with cash of $313 million, and they say there's no debt. The company was previously GAAP profitable on quarters prior to their IPO, and adjusted EBITDA was $41 million, which was up 88% year over year. This current Q3 quarter had GAAP expenses related to the IPO, so it's hard to know how the profitability really came in on this latest quarter, but the adjusted numbers help. The guidance the company gave for the next quarter is from $680 to $700 million of revenue, which would be up 36% year over year. They did mention they have a strong comp versus the previous Q4, and that might be why the revenue growth rate would be down on their guidance. They also guided adjusted EBITDA in the next quarter to be from 38 to 40 million. And that's actually not a great sign to see that revenue would be stepping up, but adjusted EBITDA in a lower range. Although I think management might be sandbagging on their guidance, it's hard to know because there's not much of a public history for this company. Net retention rate in the latest quarter was 122%, and that number was just 116% in the S1, and it was lower before that. International revenue was up 72% year over year and makes up 8.3% of revenue currently. Growth from Coupang accelerated in Q3 faster than any other marketplace that's been onboarded before. Pattern had 4.5 million of revenue from Coupang in this quarter, and they expect 6.5 million in the next quarter. The company is diversifying amongst products and marketplaces significantly. And they're coming off small bases, but ramping up significantly. For example, Walmart sales were up 96% year over year, and TikTok shops were up 392% year over year. The stock price for Pattern Group has drifted down significantly since the IPO. It started around $15, got up to around $20, and now sits at $12. That's encouraging to see from our perspective as an investor that some of the hype around the company has fallen off, and now the price seems way more attractive. Our biggest concern here is that Amazon is still the top marketplace by a long shot, and that's a risk to the company. We'd like to see Pattern to continue diversifying its revenue streams on their next earnings report. The next company we own is also a new stock for us. It's called Shoals Technologies with symbol SHLS. Their product is utility scale solar solutions, and they're entering the battery storage system market. They have a plug-and-play electrical balance of system called EBOS for the solar market. and their platform is able to monitor and control from real-time performance. Battery energy storage, with acronym BESS, is growing, but it's still off of a small base. And the company mentioned they have a competitive advantage. There's a large client list who trust Shoals to implement their utility scale solar, and now they can upsell their existing clients to the battery energy storage solution. Stepping back for a moment with some more basic company details, the market cap is $1.5 billion, and this company was founded in 1996. They IPO'd in 2021, and the headquarters is in Tennessee. The financials in the latest quarter were that revenue landed at $136 million, which was up 33% year over year. Adjusted EBITDA was $32 million, and GAAP net income was $12 million. This is with a gross margin of 37%. And we really like this guidance the company gave for their Q4. It's for revenue of $140 to $150 million, which would be up 40% at the top end of the range. And the guidance also included adjusted EBITDA guides of $35 to $40 million, keeping in mind the previous quarter was $32. So it seems like profitability is stepping up as well. The company has a record backlog of $721 million, which is up 21% year over year. They also mentioned on the latest quarter that quote volume exceeded 900 million, which is greater than 20% quarter over quarter growth. So it seems like inbound leads are increasing. The management team detailed that progress in all three business lines is meeting or exceeding expectations. And they said there's higher domestic project volume from both new and existing customers. Yet the opportunity to expand in international markets continues to expand. The best segment for battery storage already signed 2 agreements, and there's a backlog of 18 million. It's still pretty small, as we mentioned, but this battery storage market is growing. And on the battery storage market, they said they could be partnering with EPCs directly, and they talked about a sale to a hyperscaler as well. On the battery storage market, they mentioned it's a very young and evolving market. We're very excited about it, they said, and it's bigger than they expected from 1 year ago. My top concerns include that this company has $166 million of debt. It's not huge, but it's about 10% of their market cap. The company also had to pay out $70 million in a remediation fix because of a supplier issue. There was some bad wiring that Shoals got from a supplier, and they had to fix it for their customers. This wire manufacturer is a big company, and they said normally their reliability is good. But it sounds like this is a one-time issue that'll get worked out. Lastly, the management team did detail that they're impacted by aluminum tariffs. But they didn't make it sound like the aluminum tariffs are that big a part of their business, and they did give higher guidance, so that gives us some confidence here. The last company we own is Organigram, with symbol OGI. They're a Canadian-based cannabis producer, and the company just reported calendar year Q3 earnings. They had net revenue of 80.1 million Canadian dollars, which was up 79% year over year. And that's roughly 58 million of USD. And my data provider provides numbers in USD while press releases are in Canadian dollars, so there is a little bit of work to figure out the difference. Analysts had been expecting low 50 millions USD for Q3. So this company did have a significant beat versus the analyst estimates. Adjusted EBITDA in the quarter was 9.8 million, which was up 69% year over year. And adjusted gross margin came in at 38%, also improving over time. The management team said the 38% gross margin is good, but they're not satisfied. One aspect of this business, which is growing really fast, is international revenue. That was 26.3 million, which is up 173% year over year. And the company said they expect international sales at significantly higher rates in the coming year. Additionally, they mentioned they anticipate incremental margin lift from continued international growth. And I thought that was really encouraging to see that international pushes up their margins. A lot of times when a company releases a new product or enters a new business line, their margins go down as they try to figure out how to scale it. Organigram's Canadian market share makes up 11.9%, and they're the leader in a fragmented market. The company also completed its EU GMP, or Good Manufacturing Process audit, and now they're just awaiting confirmation and certification in the EU. They can already sell in the EU as is, but this GMP certification will bring even more margin as they don't need to deal with third parties. The company had a record harvest this quarter with increased yields and capacity without expanding their physical footprint. And the New Brunswick government supported Organigram with facility enhancements and a government grant of 2 million Canadian dollars. And that's actually really surprising to see the government is sponsoring this business that much. Overall, I saw enough positive development on this earnings report to want to continue holding here. And we're looking to evaluate this company under the new CEO's leadership. The company got a new CEO recently, and we're looking to see how they do going forward. We sold one company this month, which was Evasion with symbol EVAX. The company has a platform for discovering vaccines using AI. But we ended up selling this company after Merck declined to exercise their option on EVX B2. This was one of the vaccine candidates they were currently working on. And this decline from Merck actually does allow the company to sell the EVX B2 to another pharma company potentially. However, we expected that Merck was going to take most of the company's clinical results, and we expected them to exercise most of their options. But Merck declining the candidate here made us realize we're heavily dependent on binary outcomes with this investment. Although this binary nature of results is fairly typical in biotech companies. It's just that we thought this business had a lot of momentum on finding vaccine candidates, and we didn't expect one to get declined this soon. Overall, Evasion still sounds promising and could make a good long-term investment. But we prefer companies with more consistent results and less binary outcomes. These binary outcomes make our hit rate for successful investments to be lower in this industry. And it's because the companies are more unpredictable with boom or bust outcomes. As mentioned at the beginning of the video, we have a record number of promising new ideas this month. And these are ideas that seem promising, but where we ultimately passed on investing. One new company we researched this month was Intellicheck with symbol IDN. They're a SaaS identity verification platform, and they earn revenue per scan and fixed fee contracts. Revenue in the latest quarter was $6 million, which was up 28% year over year. They had EBITDA of $0.4 million and net income of $0.3 million. Gross margin for this company is listed as 91%. And even though these numbers are pretty small, it's an impressive set of financials to be GAAP profitable. This is a much older company that had its peak value in 2002, but now they're getting record revenue. I ended up passing here because the story sounded stronger than the numbers posted. Additionally, they mentioned that the retail segment is down while other verticals are doing well. Ideally, you'd like to see a company this small having all verticals doing well and not having one falling off like this. Another company we looked at is called Flywire Corporation with symbol FLYW. They're a SaaS payment solution, and they got their start making student tuition payments easier. The company has clients in education, healthcare, travel, and B2B. And their business model works by getting transaction-based payment fees across different verticals. Revenue in the latest quarter was $200 million, up 28% year over year. The revenue growth is a little on the low side of what we typically look for, but with EBITDA, they got $37 million and net income of $30 million. So the company is highly profitable already, which is unusual for a SaaS company of their size. The market cap is 1.75 billion. One of the reasons holding us back from investing here is they have two medium-sized acquisitions over the past 2 years, and this makes it hard to evaluate apples-to-apples comparisons on the financials. One more company we researched in the month was Etoro Group with symbol ETOR. They're a multi-asset brokerage platform with social trading, and their headquarters is in Cyprus. The company measures revenue in a strange way that is not the industry standard that Coinbase or Interactive Brokers use, for example. They use trading volume as their revenue. Despite this drawback, the company has gross profit of 92 million, net income of 57 million, and their headline revenue number is up 166% year over year. The price has come down significantly since the IPO, and it looks cheap in comparison to competitors. I'm also not sure about the headquarters location in Cyprus and if that's to skirt regulations. I'd probably want to learn more about how regulations work in Cyprus before investing here. Getting into some more promising ideas, we have Turning Point Brands with symbol TPB. Their product is rolling papers, chewing tobacco, and nicotine pouches. The company has distribution solutions with logistics for routing to convenience store channels. The financials here seem reasonably compelling. They had revenue of 119 million, which was up 31% year over year. And they're also GAAP profitable with EBITDA of 29 million, net income of 21 million. And that's with a market cap of 2.05 billion. I'd be interested here to see if this company can continue to accelerate financials. They mention they have better brand recognition now, but I want to see if that translates into the numbers. The next company is Life360 with symbol LIF. They're a subscription platform for location sharing on mobile applications, and they do driving safety as well. Subscriptions make up most of their revenue, with 77% of revenue being those subscriptions, and then 14% from ads and 9% from hardware sales. On the financial side, the company has 125 million of revenue, which was up 34% year over year, and they're GAAP profitable with EBITDA of 10 million, net income of 10 million, and they have a gross margin of 78%. The market cap for this company is already 5.3 billion, which is quite large for that revenue level. The implied revenue guidance for the next quarter is 141 million at the top end, which would be a pretty big jump up. And that guidance they gave does have me interested here, but I think the valuation just seems too high, being over 5 billion. I can't really see this company becoming a $20 billion company anytime soon. One more company we looked at was Klaviyo with symbol CVYO. They are a SaaS-based customer engagement platform that's built around email and SMS. And their product is focused around B2C e-commerce brands. Their solution ingests data from Shopify and other platforms. On their last earnings report, revenue was 311 million, which was up 32% year over year. They had EBITDA of negative 5 million and net income of 0. So they're right about break even on a GAAP profitability basis. Gross margin is a reasonable 76%, and the market cap is 9.9 billion. Overall, I thought this company seems like a decent run-of-the-mill SaaS business, but I'm not sure they can beat expectations significantly from here. The market cap of 10 billion seems to have this stock fully priced for right now. The next company we looked at is called Via Transportation, with symbol VIA. They're a transit operating platform with software on demand for schools and government. The company just went public in September 2025, and on this first earnings report, they posted revenue of 110 million, which is up 32% year over year, but the company's still unprofitable. Government contracts make up 90% of the revenue, and they mention there's hard initial sales, but once they land a customer, they're pretty reliable customers. One interesting aspect is that management says the platform is growing by word of mouth as they become larger. That may help increase their sales funnel naturally. So we'll keep an eye on VIA and see what they can post on future earnings calls. Looking at more promising new ideas, we have Shift4 Payments with symbol FOUR. They are a payments platform that is scaling up with an attractive valuation. Revenue in their most recent quarter was 1.18 billion, which is up 29% year over year. They had EBITDA of 252 million and net income of 28 million, with a gross margin of 37%. That gross margin of 37% is notable because 1 year ago it was 29%, so it's good to see that's moving up. The market cap for this company is 5.7 billion. And usually when a technology company has over $1 billion in quarterly revenue, you'd expect the market cap to be a lot bigger. However, Shift4 does have a lot of acquisitions, and the most recent one is a pretty big one. The company's called Global Blue, and that was for $2.5 billion. Global Blue helps expand the company's reach to Europe more. But one additional concern we have with this company is they do have 4.8 billion of debt, and that's quite large compared to their market cap. The company says they're able to effectively integrate other platforms. I would like to see this company lap some of their acquisitions so we can see how the growth actually looks if it's not just buying other companies. But the run rate price to sales of 1.2 seems really cheap for a technology company, so we may keep our eyes on this one. Another company we took a look at in the month is called Prenetics Global with symbol PRE. They're a Hong Kong-based supplements company that's seeing accelerating sales. And they're promoting with star athletes from soccer and tennis. The most recently quarterly financials show the company got 23.6 million of revenue, which was up 203% year over year. But this company's not profitable yet. They had EBITDA of negative 5.3 million and net income of negative 7.4 million. Normally, a supplements company that is deeply unprofitable like this wouldn't be of much interest. However, our main interest here comes from the guidance. The top end of their guidance implies 44.1 million of revenue next quarter. And that would be a massive step up both quarter over quarter and year over year. Additionally, the company said they expect to get over 200 million of revenue from just drink powders next year. So we'll want to keep our eyes on this one and see if they can actually deliver that step up in revenue. This company also probably competes with BioHarvest, so it may be interesting to track that as well. The next company we looked at is Genasys with symbol GNSS. They are an emergency communication platform, and revenue is split between SaaS and hardware sales. Revenue in their last quarter was 17 million, which was up 153% year over year and 72% quarter over quarter. The company is close to getting to break even on GAAP profitability. This most recent quarter benefited from a contract with Puerto Rico. It seems like that revenue will continue into the next quarter, but I noticed that analysts project 17 million for the next quarter as well. I don't put too much weight on analyst estimates. They might just be filling in the blanks. But I was having trouble understanding how future quarters would be impacted by this Puerto Rico contract. There's also no guidance given by this company, but the valuation is just $100 million of market cap. And that's considering there's 17 million of revenue in the latest quarter. So Genasys does seem really compelling from a valuation standpoint. But something to keep in mind is this is a low volume stock. Another company we looked at in the month is called Rekor Systems with symbol REKR. They're an AI-powered roadway intelligence platform with traffic analytics. This includes vehicle analytics, incident detection, traffic management, and license plate recognition. On their last quarterly report, the company had $14.2 million of revenue, which was up 35% year over year. But the company is still unprofitable, with negative 4.1 of net income. The market cap for this company is $205 million. And it will be interesting to see if this platform can catch on more. We would want to see either higher growth or more profitability first before investing here. Now let's take a look at some promising new ideas in the healthcare space. The first is the Oncology Institute with symbol TOI. Their oncology care platform gets revenue from patient services. They have a focus on adults and seniors, and they're working with Medicare Advantage and Medicaid. Revenue in the latest quarter was $137 million, which was up 37% year over year, but the company had a net income of negative $17 million and low gross margin of just 14%. The company has an attractive valuation with a run rate price to sales of 0.7, and that could get more attractive as they continue to grow. But there's still a lot of regulatory uncertainty around Medicare and Medicaid, so we want to stay away for now. Another healthcare company we looked at is called Talkspace with symbol TALK. They have a virtual mental health platform that connects users with professionals. And they're a B2B payer with employment contracts, so they have no direct-to-consumer business. Their latest posted revenue landed at $59 million, which was up 25% year over year. And they had EBITDA of $2.9 million and net income of $3.3 million. So it's encouraging to see the company's already GAAP profitable. And they have a market cap of $581 million and a cash balance of $92 million. One thing that's got us interested here is the next quarter guidance implies $70 million of revenue at the top end, which would be up 43% year over year. And that's a big step up from growing at 25% in the latest quarter. However, the company did lower their full year guidance on EBITDA. We'll want to wait to the next quarter to see if they can actually get that revenue step up and where they guide to next. Another company we looked at is called Caris Life Sciences with symbol CAI, and they did a recent IPO in June of 2025. They do molecular profiling tests for cancer patients, and their test helps guide therapy selection or early detection programs. The financials look really impressive here with revenue of $217 million, which is up 113% year over year, EBITDA of $38 million, and net income of $24 million. But this current quarter benefited greatly from what they call true-ups. So they got more reimbursements back than they expected this quarter. But the next quarter guidance and analyst estimates seem to project flat sequential revenue, and that true-ups benefit is not continuing into the next quarter. So this is another company we want to see one more report on before reevaluating. The next company we looked at is called Hinge Health with symbol HNGE. They're a healthcare platform that also went public in 2025, and they treat shoulder, hip, knee, and joint issues. On their Q3 earnings report, they had previously guided for 141 to 143 million of revenue, and they landed at 154, which was a pretty big beat, and up 53% year over year. The company is getting close to break even on profitability now. The market cap for this company is $3.6 billion, and they have an impressive gross margin of 82%. The number of clients they have grew 25% year over year. So I'd be interested to learn why revenue is growing so much faster than clients. They may be providing more value to their users now so they can charge more. What's holding me back from investing here is the next quarter for Q4 is guided revenue from 155 to 157 million. So that would basically be flat quarter over quarter, although the company did beat the recent guidance. They mentioned there may be some seasonality, so we want to see how that Q4 guidance lines up year over year as well. Now let's take a look at some promising new ideas from overseas, but which are still listed on US exchanges. The first is BitFuFu with symbol FUFU. The company went public as a SPAC in 2024, and they're a Singapore-based Bitcoin miner. They do cloud mining solutions and sell hardware equipment. The market cap is just 420 million, but the company has a lot going for it. They've got 36 exahash of Bitcoin mining capacity with 624 megawatts of power capacity. This makes up about 3% of the global Bitcoin mining market. The company has 190 million of Bitcoin on their balance sheet. And their latest quarterly numbers showed they had revenue of 181 million, which is up 100% year over year, with EBITDA of 10.2 million and net income of 11.5 million. The company has said they have no ambitions to move to high-performance compute. But this company does seem attractive on a valuation basis alone, and it does have Singapore-based regulations. The next company we looked at is called Brainsway with symbol BWAY. They're an Israeli-based company that does neurostimulation treatment using a helmet and coils. And they have a recurring revenue model with installed systems to treat depression, OCD, and addiction. Revenue in the last quarter for Brainsway was 13.5 million, which is up 29% year over year. The company is GAAP profitable with 1.6 million of net income and a market cap of 335 million. The company guided next quarter's revenue to be 14.4 million at the top end. And this company has a long cash runway. This seems like an interesting company, but there wasn't enough to get excited about. And the valuation already has some optimism priced in for this company. Another company we looked at is called Waterdrop with symbol WDH. They're a Beijing-based tech-driven platform for healthcare and insurance. Their platform connects consumers with life and health insurance. And they also help support medical crowdfunding for expensive operations in China. The company does have impressive financials with revenue of 137 million, which is up 38% year over year. And they are demonstrating profitability with EBITDA of 16 million and net income of 22 million. The market cap for this company is 700 million. Overall, Waterdrop did sound more like a tech company than I was expecting. And the risk reward does seem pretty reasonable here. The last company we looked at is called Zunlei Limited with symbol XNet. They're a Chinese subscription-based service for shared clouds and live streaming. Their latest quarterly results included revenue of 126 million, which was up 58% year over year. The company had EBITDA of 4.4 million and a huge net income over 500 million from a GAAP reconciled investment. And the reason they got so much GAAP net income is they hold 8% of stock in a company that grew to a 16 billion valuation called Arashi Vision. And Arashi is a Chinese company with the stock symbol 688775. And this company looks super interesting when the market cap is just 450 million. This is because they have an over $1 billion investment in Arashi Vision. They have 284 million of cash, and they're a growing business. But this is a really complex story here in an overseas market we don't understand too much, so that's keeping us from investing. Let's wrap up with some concluding thoughts on the year. Our first year as a full-time investor is completed. And we're obviously pleased with the results, getting another 100% return on the year. We'd actually started the year planning to work on a book on growth investing, which is still in progress. However, in February, we began front-running some of the content from the book as the channel Growth Investing Mastery on YouTube. So I wanted to give a special thanks to our listeners for helping improve the content. We've got tons of great comments and questions that have come in over the course of the year, helping us refine the content further. And any comments or questions in general are always welcome on the channel. And lastly, just to remind again, this is not investment advice or recommendations to buy stocks. Thank you for listening.